Good day, guys. Welcome to a brand new video. Today we're going to talk about candlestick analysis. This is something very simple, but also very powerful if you truly understand it. Now, candle analysis is simply about understanding how each candle closes and what that close tells you about the market. Because at the end of the day, every single candle is telling you a story. It's showing you the battle between buyers and sellers. Price moves up, price moves down, but where it finally closes, that is what really matters. If a candle closes above the previous candle's high, that tells you buyers are in control. Not only did they push price up, they were able to maintain that strength all the way to the close. And that usually suggests that price has a higher probability of continuing upward. On the other hand, if a candle closes below the previous candle's low, that tells you sellers are in control. They dominated the market and held that control into the close, which means price is more likely to continue downward. Now, beyond just candle closes, this is where things start getting interesting. Candle analysis also helps you identify rejections, and these are what we call candle sweeps. A candle sweep happens when price tries to move past a previous high or low, but fails to close beyond it. And that failure is very important. Let's take a bullish example. Imagine you have a bearish candle, and then the next candle starts forming. Price pushes lower, even goes below the previous candle's low, so it looks like the market wants to continue downward. But then, something changes. Before the candle closes, buyers step in. They push price back up, and the candle ends up closing above the previous candle's low. That right there is a bullish candle sweep. What does that tell you? It tells you sellers tried to push price lower, but they failed. Buyers came in, overpowered them, and took control before the close. And remember, the close is what matters most. So if buyers are in control at the close, there is a higher probability that the next candle will move upward. Now let's flip it. Price tries to move above the previous candle's high, maybe even breaks above it briefly, so it looks bullish. But before the candle closes, sellers step in aggressively, push price back down, and it closes below the previous candle's high. That is a bearish candle sweep. It tells you buyers tried, but they couldn't sustain it. Sellers took control at the close, and that gives you a higher probability of downward movement. Now here's something very important. Candle sweeps are powerful because they show you failed moves. And in trading, failed moves often lead to strong moves in the opposite direction. Now, to help you understand this even better, I've put together some examples for you. These are different variations of how bearish and bullish candle sweeps can actually form. Right here, we have different variations of the bearish candle sweep. And right here, we have different variations of the bullish candle sweep. Now, if you look closely, you'll notice that they don't always look exactly the same. Sometimes the wick is stronger. Sometimes the body is smaller. Sometimes price pushes further before rejecting. But the key thing you should always focus on is this: the failure to close beyond the level. That is what defines the sweep. Not how it looks, but what it does. So don't get too caught up trying to memorize shapes. Focus on understanding the behavior behind the candle. Now, even though we understand candle sweeps, there are certain types you should completely avoid. First, the invalid candle sweep. This is when price sweeps both the high and the low of the previous candle. So you'll see a wick above the high and a wick below the low, all in the same candle. What does that mean? It means the market is in complete indecision. Buyers pushed up, sellers pushed down, and nobody is clearly in control. This is the type of candle you avoid completely. Now, the second one is different. These are known as inside bar candles. What these inside bar candles mean is that price could not move above or below the previous candle's high or low. It stays completely within the range. At first glance, this looks like indecision. And yes, it is. But this is where many traders get it wrong. This type of candle can still be used, but only with proper context. Let's break it down. Imagine price closes below the previous candle's low. That already gives you a clear bearish expectation. Now the next candle forms, and it becomes an inside bar candle. It doesn't break the high, it doesn't break the low. Most traders will get confused here. They'll think the market is reversing, but that's wrong. You do not change your bias. Why? Because the market has not yet delivered the move you were expecting. That inside bar candle is just a pause, not a reversal. So you stick with your original analysis and continue expecting price to move downward. Inside bar candles don't change direction, they delay direction. Now, let's talk about something very important: targets. Because one thing is knowing you're bullish or bearish, but another thing entirely is knowing where price is likely to go. You need a clear target. Let's start with bearish scenarios. If price closes below the previous candle's low, that gives you a bearish confirmation. Now, where is price likely to go? Your target should be the low of that new candle. So what you're expecting is for price to push down and take out that low. Another bearish setup: if price sweeps the previous candle's high and closes back below, your target becomes the previous candle's low. Simple, logical, clean. Now for bullish. If price closes above the previous candle's high, that gives you a bullish signal. Your target becomes the high of the new candle. And if price sweeps below, but closes back above, your target is still that high. Now here's the tricky part. Once price takes out that high or low, you need to be careful, because at that point, the move has already been delivered. So instead of chasing price, you should be entering before the target and taking profit at that level. Simple way to remember this: bearish confirmation, target the low. Bullish confirmation, target the high. That's it. Keep it simple. Direction give you bias, but targets give you precision. And without targets, you'll either close trades too early or hold trades for too long. Now, let's go to the chart. Let's use what we've learned and break this down step by step. So this right here is the Euro-USD daily chart. Now the first thing we can observe is the last two candles. You can clearly see that price swept the previous candle's high and then closed back below it. That is a bearish candle sweep, which tells us we should be anticipating bearishness the next day. And as you can see, price actually sold. Now, moving forward, the next day price closed below the previous candle's low. Again, that is a bearish signal. And what happened? Price continued to sell. Then again, we see another close below the previous candle's low. Still bearish. And as expected, price keeps pushing downward. Now at this point, we also have a close below the previous candle's low. That reinforces our bearish bias. Now the question is, where is our target? Our target should be this recent low. And what did price do? Price came down and took it out. Now after taking out that low, we are still bearish. So we now anticipate that the next low will also get taken. And what happened? Price did exactly that. Again, we have another close below the previous candle's low. So naturally, we expect continuation to the downside. And yes, price delivered that move. But now, this is where things start to change. Price sweeps this candle's low, but instead of continuing downward, it pushes back up. That is a bullish rejection. So now, our bias shifts from bearish to bullish. So what do we expect now? We expect price to come up and take out this high, and potentially even push higher. And what happened? We got a strong, impulsive move to the upside. This is also a close above the previous candle's high. So again, We anticipate that this high will get taken, and price did exactly that. Now again, we have another close above the previous candle's high, so we expect continued bullishness. But here, we get our first inside bar candle. Now remember what I told you. Inside bar candles do not stop your analysis. They are just a pause. So even here, we continue anticipating bullishness. And what happened? Price pushed higher. Now here, we get a sweep of the previous candle's high and a close back below. That gives us a bearish signal. So we expect price to at least come down and take out the previous candle's low. But this time, it didn't play out immediately. We got an inside bar candle, and after that, price didn't deliver. And this is important because this concept doesn't work 100% of the time. Now moving forward, we get a close above the previous candle's high, so we expect this high to be taken. But again, price forms another inside bar and still doesn't take the high. And after that, it pushes down. So we got this one wrong again. Now price closes below the previous candle's low, so our bias shifts again, back to bearish. We now expect this low to be taken. And what happened? Price took it out and continued downward. Again, we see another close below the previous candle's low, so we expect more bearishness, and price delivered. Now, this part is very important. Price takes out this low, but then we see a rejection candle. Price tries to close below, but pushes back up, leaving a wick. That is a bullish signal. And if you look closely, we also have a bullish fair value gap in this area. So now, we're combining candle analysis with another confluence, which increases the probability of price moving upward. Now the next day, price pushes up, takes out this high, but it forms an invalid candle sweep. We have a sweep above and a sweep below. So this is a candle we completely avoid. After that, we get an inside bar. So at this point, we stay cautious. The best thing to do here is to wait for clear direction. Now the next day, we finally get it, a bullish candle that closes above the previous high. So now, we expect this high to be taken, and price delivers. Then again, we anticipate the next high. Price takes it out, but leaves a wick. Now that wick suggests we may see a pullback. So we now expect this low to be taken, and price does exactly that. Now if you look closely, this area aligns with an inverse fair value gap, which again adds confluence. And what happens next? We get a strong, impulsive move to the upside. Even here, we see a rejection candle, but price still closes above the previous high. So overall, the market remains bullish. Then we get another inside bar, but again, this does not stop our analysis. It's just a pause. And finally, price pushes up and completes the move. So this is how this concept works in real time. This is how you can read the market step by step and anticipate where price is most likely to go. Now, as you can see, it's not 100% accurate. We had a few losses, maybe 2, maybe 3, but overall, it works very well. And when you combine this with other confluences and then refine your entries on lower time frames, you start to gain a lot more precision in your trading. If you found this helpful, make sure you like, subscribe, and I'll see you in the next one.